Welcome to The Explainer. Today, we are diving into a quiet revolution that is already, right now, changing how money moves around the globe. It's a massive, high-stakes competition to build the financial system of tomorrow. And believe me, it's happening a lot faster than you might think.
So let's just start with a number, $28 trillion. In 2024, a single technology is on track to process that much value. That's trillion with a T. And look, this isn't some far-off prediction. This is happening as we speak.
To give you some perspective on that number, it's more transaction volume than the payment giants Visa and MasterCard processed combined. Just stop and think about that for a second. Every single time someone swipes a credit card, every online purchase on those massive networks, and this new technology is already handling more value. So what on earth is it?
Well, the answer is a new kind of digital currency called stablecoins, and they are quietly but very quickly taking over the global financial system. They're basically digital tokens, usually pegged to a stable asset like the US dollar, and they are completely rewriting the rulebook for finance.
Okay, so to really get why this is happening, we have to take a quick look at the old system. The way we send money across borders today, it's built on a framework from before the internet even existed. It's ridiculously slow, it's expensive, and honestly, it's broken. This old, clunky system basically acts like a tax on the entire global economy. I mean, if you've ever tried to send money to family overseas, you know this pain firsthand. The World Bank found that sending just $200 costs, on average, over 6.5%. That's money that just vanishes into the system instead of getting to the people who actually need it.
And the reason it's so bad is this crazy, complex web of so-called correspondent banks. Your money doesn't just go from point A to point B. Oh no. It takes this multi-day detour from your bank to another bank, then probably another one, before it finally gets where it's going. And every single stop on that journey adds more costs and more delays. It's like trying to mail a package using the postal system from the 1970s.
So, what's going to replace it? Well, right now, two very different models are competing to become the new operating system for money. And this isn't just about different kinds of technology. It's about two totally different philosophies for how our financial future should work.
On one side, you've got central bank digital currencies, or CBDCs. You can think of this as digital money that's issued directly by a government's central bank. So it's like a digital version of the cash in your wallet, except it's created, issued, and tracked directly by the state.
The best example of this is China's digital yuan, the e-CNY. This is a classic top-down, state-controlled system. They rolled it out for the Olympics, and to get people to use it, the government even started paying interest on it. But here's the crucial part. It's designed from the ground up to plug right into state surveillance tools. And of course, all private competitors, like other cryptocurrencies, have been completely banned. And then, on the other side of this competition, you have stablecoins. Now, unlike CBDCs, these are issued by private companies, and they're designed to hold a steady value, usually by being pegged one-to-one with a major currency like the US dollar.
These are completely market-driven, and the way they keep their value stable is by holding reserves of really safe, liquid assets. You can see right here, the vast majority, we're talking around 80%, of those reserves are held in US Treasury bills, which has this fascinating side effect. It makes stablecoin issuers some of the biggest buyers of US government debt in the world.
So you see the fundamental difference here, right? It's all about the philosophy. With CBDCs, it's about state control, a centralized top-down system. With stablecoins, it's about market-based choice, a system built by private companies that have to compete with each other and innovate on open platforms. It's the state's money versus the market's money. And look, this is not just some theoretical debate for economists to argue about. It is a real-world competition playing out right now. In the main arena, the key testing ground is Southeast Asia, where entire nations are trying to decide which financial future they want to plug into.
This quote really just illustrates the geopolitical stakes perfectly. As one analyst put it, for a country to adopt the digital yuan is like outsourcing its economic master keys. Think about that. China becomes the system administrator for your country's money, with the power to monitor all the traffic, or maybe even shut down the whole network.
And we're seeing this play out all across the region. China is pushing its e-CNY through its massive trade deals. At the same time, Japan and South Korea are funding private stablecoin projects to offer an alternative. And in unstable places like Myanmar, stablecoins have become a kind of shadow infrastructure, a financial lifeline that operates outside of direct state control.
Now, with this technology moving at lightning speed, governments all over the world are absolutely scrambling to write the new rules of the game. The big challenge is figuring out how to encourage all this innovation while still managing the very real risks.
What's really interesting here is just how different the approaches are. China just went for an outright ban on all private crypto. Why? To clear the runway for its own e-CNY. But in sharp contrast, you have places like Hong Kong, the EU, and the US that are trying to create regulated frameworks, basically clear guardrails so private stablecoins can operate safely.
So, after all that, why should you care about this high-level, kind of nerdy financial plumbing? Well, because the outcome of this race, this battle between state-run money and market-driven money, is going to fundamentally shape your financial future.
The whole debate really boils down to a critical trade-off. Even the U.S. Federal Reserve Chair, Jerome Powell, has openly worried about a world where the government has a real-time window into every single transaction you make. It's that classic conflict. What's more important, efficiency or privacy and control?
And this isn't just about technology, right? It's about core values. We're talking about your individual privacy. We're talking about economic freedom and whether a government could one day just use a kill switch on your funds. It's about whether the future of finance is going to be built on open, innovative platforms or closed, state-controlled ones.
Interestingly, the end game here might not be a winner-take-all scenario. A lot of experts are now saying that the best way forward is actually a hybrid system, one where regulated, private stablecoins handle all our everyday payments, while specialized CBDCs are used behind the scenes for massive settlements between big banks. But at the end of the day, the central question remains, and it's a question we're all going to have a say in. When it comes to the future of our money, what do we want to build it on? A system of command or a system of choice?